All here, and other people might log on as we start, so no worries. Hi, Sam. So we'll go right ahead. So today's infusion workshop is startups and investing. So what you need to know. It's going to be presented by Norton Rose Fulbright and Panache Ventures. So today's speakers, we have first Scott Long, who's a partner at Panache Ventures. We also have Bianca Pietracupa, who's associate lawyer and trademark agent at Norton Rose Fulbright. We also have Mathieu Deschamps, who is a partner and also part of the business law group at Norton Rose Fulbright. So in this series of workshops imagined by Zoo, we support entrepreneurs by addressing key concepts related to startup development. So we help them structure their business projects and also ensure their growth. So startups have turned to many traditional industries upside down over the past decades with their agility, enabling them to solve problems that previously seemed impossible. And despite their high potential, some startups lack capital when they're at their seed stage, and they spend a great deal of time and resources seeking funding. However, once investors are hooked, they can quickly become strategic partners and long-term allies. So that's why you need to be well prepared to gain the trust of those who will invest time and money in your business. So in this workshop, in collaboration with Norton Rose Fulbright and Panache Ventures, we'll cover, there'll be two parts of the presentation. So the first 20 minutes will be presented by Scott from Panache Ventures. So he'll be covering how to seek financing sources according to the needs of your business, capital raising, how to present your financial plan with the right components to address the right audience. He's going to be looking at financial statements and common mistakes to avoid, tips and tricks to impress stakeholders and potential investors, and finally, how to present your financial plan with the right components and avoiding common errors. In the second portion, Norton Rose Fulbright will be presenting how to prepare for an audit and due diligence report, looking at all contracts and agreements that are signed, and how to identify the right private and public funding resources for your business. And finally, the last 20 minutes will be allocated for any questions you might have. So please feel free to either raise your hand, or if you're more comfortable with writing, feel free to write your question in the chat. There's no problem there. So without further ado, I'll let Scott start his presentation.
Thank you, Sasha. So it's a pleasure to meet all of you. My name is Scott. I am a partner at Panache Ventures. We are Canada's leading pre-seed and seed stage venture capital fund. And if you don't know what pre-seed or seed means yet, no worry. We'll get through all of these qualifiers and basics and things like that over the next few minutes. We have $58 million in our fund, which we've deployed nationally. I have partners in Toronto, Calgary, Vancouver, and obviously I have a partner in Montreal as well. I lead the investment team here in Quebec, which means I cover all of Quebec as well as Atlantic Canada, as a matter of fact. It's a big territory to cover. Let's just jump straight into it because we don't have a lot of time. I encourage you to write down your questions or to raise your hand during this session if there's anything that you want to ask me about. But I figured that we would cover a lot less than was on the sort of bullet pointed list that we had planned. And instead, I'll try and give you some insights on what it's like to raise capital from Panache Ventures as a founder. I was a founder up until 2019 when I sold my company and I joined Panache as a partner earlier this year. So hopefully this will be really helpful for you because I think that there are a lot of mistakes that early stage companies will make when engaging in fundraising activities. So Venture Capital 101, key concepts for founders. Before we get into the mechanics of how you'll actually engage with venture funds, let's talk a little bit about what are the venture capital incentives and economics. So how does the industry actually work? Because if you understand how venture capital funds and venture capitalists think, it will be a lot easier for you to engage with them. So the first is this idea of LPs and GPs. So I'm going to call on Valerie. Valerie, do you know what an LP of a venture fund is? You can give me a thumbs up or go ahead.
Help you? No, I don't know.
Okay, so LP, the P, it means partner, and the G and the L, respectively, they mean general partner and limited partner. And without getting into the nuts and bolts of how liability is split between these two different entities, what we can really think of is the LPs are institutions that invest money into venture capital funds. And the GPs are people like me. These are the people that you're going to interact with when you engage with a venture capital fund. So the partners, the principals, the associates, and the analysts all are on the GP side. And the LP side of things, we can talk about a typical LP being an endowment fund of a university, a pension fund, or a sovereign wealth fund. And essentially what you can imagine is a very, very large pool of capital that's collected over the course of, let's say, a year, either through contributions to pension funds or through taxpayer dollars. Let's take, for example, the Sovereign Wealth Fund of Norway, which is the biggest sovereign wealth fund in the world. They may have $1 trillion under management. And out of that $1 trillion, let's just say that most of it, maybe 90% of it, will be invested in very safe and secure investments. And this might include the public markets, it might include government bonds, it might include GICs, things like that. Things that are fairly certain to provide a small and predictable return for that investor. Now, there's going to be a little bit more. So let's say there's 10% of the fund, which is going to be reserved for what's called alternative assets, right? And alternative assets could be things like real estate, things like infrastructure projects, and also venture capital funds. So what's important to understand is that these sort of large institutions are ready to take significant risk, but only with a small percentage of the funds that they manage. So it's important to know that because ultimately, whether or not a fund considers your business to be investment grade for a venture capital fund will be dependent on how big and ambitious and risky your business model is, right? So that's a very important thing to know. So let's say I'm the Norwegian Sovereign Wealth Fund. I've got $1 trillion under management. I've got $100 billion that's allocated to alternative assets. And then I've got $20 billion that's allocated to venture capital funds. How do I pick which venture capital fund I'm going to give some money to so then they can make investments in startups? Well, I'm going to do an evaluation of what's called the investment thesis. So the investment thesis consists of several different things. It could be some funds will only invest in certain stages. So stages meaning pre-seed, seed, Series A, Series B, and follows. Panache is a pre-seed and seed stage fund, which means that our investors know that we're going to deploy capital to very early stage businesses. Oftentimes, these companies will have no revenue. Oftentimes, these companies will be pre-product. That's very different from a Series A investor who, by and large, will be looking only at companies that have a minimum of about $1 million of annual recurring revenue. That's sort of like the different stage gate. So as you kind of go from pre-seed to C to Series A to Series B, et cetera, these deals and these investments start to get bigger, and they start to get more and more dependent on the performance of the business and less on the mission, vision, ideas, and values of the founding team. Another aspect of investment thesis is thematic. So Zoo is a thematic investor in the sense that there are specific companies that will fit into their sweet spot, and they won't look at deals that are in, let's say, food tech or perhaps fintech or other or real estate tech, let's say. A final component of investment thesis would be check size. How big does a fund write a check for when they make an investment? Is it $10 million or is it $500,000 or is it $150,000? So knowing that, I think is pretty important because as we talk about later, when you engage with a venture capital fund, it's important for you to understand where does your business fit in with the investment thesis of the fund that you're talking to? Because if there's no match there, then you're going to be wasting your time. Fund life cycles is also something that generally isn't spoken about very often, but it's very important for founders to understand. Let's say when Panache raises a venture capital fund, we go to our institutional investors and high net worth investors and so on, and we collect a pool of money. We then make investments. When and how, right? The typical life cycle of a fund is 10 years, but only 4 years of that 10 years is what we call the investment period. So only during the first 4 years of a fund will a venture capital fund actually be making active investments. And that's pretty important to understand because, for example, Panache is a 2018 vintage fund. Our fund was closed in 2018, and we're 2019, 2020, 21, 2022. So we are at the tail end of our investment cycle, and we're actually in the process of raising our next fund. So if you were to speak to us about, and we didn't raise a second fund, and you were to speak to us, say, in a year and a half, we're not writing checks anymore at that point. So when you engage with investors, it's important to understand their investment thesis to make sure there's a match. And it's also important to understand where is this fund in their life cycle? Are they in that 4-year window where they're able to make an investment in your business? That's super important because you can use that as a way of demonstrating your sophistication when you engage with venture capital funds. Ask them, hey, are you making investments right now? Do you have capital to deploy? A lot of them will they'll give you an answer which is useful. It's either a yes or a no, or they'll be sort of somewhat surprised and pleasantly surprised at that you've taken the time to sort of understand a little bit about how the industry works. Okay, so you've got your business in place. Now you know a little bit about how venture capital funds work. And now you're at this stage where you're saying to yourself, okay, I would like to raise capital so that I can take my business to the next level. When to engage with venture capital funds is a question that I very often receive, and then with whom. I'm a big believer that it's very important to engage with venture funds as early as possible. Typically speaking, you should expect that it will take you about 4 to 6 months from the moment you decide you're raising capital to put together your financing round. So that's quite a long period of time. And you don't want to be starting from scratch during that period. And so in an ideal world, you start engaging with analysts, associates, principals, and partners at venture capital funds as early as possible. You have conversations which are primarily based around getting feedback of your business model and learning about their portfolios and their funds, and also just kind of creating a network of friends, of people in the industry that you can go to relatively quickly when you decide the time to raise capital is upon you. One of the misconceptions about the industry is that we often hear about the challenges of startups having to go and find venture capital funds so then they can raise money. The other side of that coin is that venture capital funds often struggle very hard to identify good companies. And if you look at how venture capital funds deploy their resources, deal sourcing is a very, very important part of what makes certain funds more successful than others. So if you understand that, funds are constantly looking to have conversations with new startups, what that gives you a license to do is just hit up anybody and everybody who you think that you can learn something from. They are waiting to take your phone calls most of the time. And we'll talk a little bit about getting introductions and cold calls a little bit later. So we know that the best time to engage with funds is early, so before you even need to raise capital. And we also know that we want to be approaching venture capital funds or any source of capital where your business fits within the defined framework of their investment thesis. That's very important. Otherwise, you may find that your time isn't as well spent as it could be. So let's say you've done a nice triage of all the possible venture funds in Canada and the US that are interesting to you because they invest in your stage, they invest in your theme, and they write checks that are appropriate for your business side. And you've got this nicely set up in an Excel and you're ready to start engaging with them. What do you actually have to prepare? I'd say there's two main things that you need to prepare. The first is your story, and the second is you need to do some thinking around how you want to structure the deal that you would be engaged with. So the story, the primary vehicle for delivering your story is going to be your slide deck. Your slide deck, typically it's going to be between 15 and 20 slides. And what you're looking to do is provide a very compelling narrative for why your business is going to be a huge international force to be reckoned with. I can't overstate enough how important it is to have a very ambitious strategy for your business. It is not a good thing to say, I'm going to own all of Ontario or all of Quebec, and then I will expand slowly across Canada. It is not a good thing because, as I mentioned at the beginning, the investors who give money to venture capital funds are doing so with a mind towards taking significant risk. And your business needs to be ambitious in order for it to be consistent with that idea. So make sure that when you tell your story, don't sell yourself short. Don't focus on the first one or two customers that you've obtained and that you're this close to being profitable, or you're this close to breaking even on your initial debt, let's say. What you want to do is tell us a version of the future where your business is the winner of a winner takes most or winner takes all market. The next thing you should think about is your financial model. Your slide deck and your financial model sort of go hand in hand in terms of being able to present your business in a way that investors can digest. Your financial model is more than just pure financials. What you should think of is you're making reasonable projections about the future, and those projections include a lot of different assumptions that are going to be stress test if you make it past the first couple hurdles, right? If you are forecasting that your revenue will be $100 million in 18 months from now based on this massive and unsustainable growth rate for which you have no clear evidence to support, that's going to be uncovered during the due diligence process. What you need to show is a credible story told through numbers on what you're going to do with the revenues and cash flows and expenses and investments that an investor might provide for you. Now, finally, the last thing that I would think of in terms of preparation is to understand deal structures and different options that you have. So usually for the kinds of investments that Panache would make at this early stage, we will do it through a mechanism called a safe note. A safe note is a type of convertible debt. And basically the benefit of using a safe note over a more conventional financing, which I think our team from sorry, is it Norton Rose is, or Brianka, I'm sorry, what firm are you?
You got it right. You got it
Yeah,
right the
you're
first
right.
time.
I'm so embarrassed. I blanked and I was like, okay. So Norton Rose is going to tell you a little more about equity and priced rounds, I believe. I don't want to front load their presentation, but essentially there's different ways of doing this, okay? And going through a safe note, which is the most common form of investing at very early stages, will enable your business to have a much quicker fundraise, because legal documents will tend to be standardized, and more or less you'll be able to raise capital with a 6-page document and a little bit of careful analysis of the contents of those 6 pages. Now, the last thing I would like to talk about, and I'm just trying to keep an eye on the clock to make sure that we're not going over. Okay, we got 4.5 minutes to talk about intros versus cold calls, which is plenty. So the most common way to engage with a venture capital fund will be through warm introductions. And warm introductions are essentially just mean you get somebody who knows that partner or that principal or that analyst, to put you in contact with them and tell you a little bit about their story. The truth is venture capital funds get a massive quantity of inbound interest, and that will typically be a little bit overwhelming, especially given the seasonality of investing schedules and that sort of thing. Different times of the year are incredibly busy. You want to, if you can, be able to cut through the noise by using a friend or a founder or a other investor that you can get yourself in front of to connect you with that investor. Generally speaking, you'll find that your success rate is significantly higher if you're able to get these warm introductions. The second way you can approach investors is through cold calling. And cold calling gets a bad rap. I think a lot of people think that it's a waste. I tend to disagree. I will generally look at every email that, or every LinkedIn message, or every Twitter DM that comes into my inbox. And I will at least look at it, okay? I won't necessarily respond to everyone. And there's a hierarchy of how I would respond. Like if it's coming through some sort of investment banker or some sort of broker for the transaction, there's a close to 0% chance I will answer. However, if you message me on Twitter and say, hey, you know, I saw this blog article that you posted a few weeks ago. I thought it was interesting. I saw that you were in a fintech business before. I'm a fintech company. It would be great if we could discuss a little bit about some of the challenges you had. Like, do something in your cold call process to enable that person to understand you've done a little bit of work and that this isn't a sort of mass email that's been blasted out to a mailing list of 500,000 investors all over the world. And you would be surprised at how infrequently people take that small amount of effort. And I believe that your success rate in cold calling investors will be extremely high if you're able to customize the messaging in your reach outs. And that's important because everyone here is an early stage founder. You may not have a significant network among venture capitalists yet. And, you know, everybody has to start somewhere. So generally speaking, I don't think that cold calling is a waste of time, but you have to do it in the right way and you have to invest a little bit of time. You can't invest that time for every single meeting you try and get into the books. And that's why it's very important that from the beginning, you understand what is the investment thesis of this fund. Are they a good fit for me? And how can I target a specific person within that organization who will want to talk to me and hear my story, which I'll then tell through my slide deck, through my financial model. And when I get in front of them, I'll have a pretty clear idea of what my ask is, how much money you want to raise, whether it's through a safe note or a priced round, etc. And I think all of these things are going to make your interactions with VCs significantly easier and your fundraise much more successful. So I'll leave it there. I think I'm pretty much right at 20 minutes. So I will send it back to Sasha.
Thank you so much, Scott. Yeah, you're perfect on time indeed. So we'll move forward with Norton Rose's presentation. So Bianca and Mathieu.
Yeah, I'll get started on this. So hi everybody. Happy to see faces that I've seen before, and I'll get to see I think in the next few days or even the next few hours. Hi Sam. What we thought we'd be discussing with you today is the due diligence process that you're going to have to go through in the context of a potential financing, whether it's equity or debt. And the reason for this is that you need to have this in mind from the very beginning of the startup story and the life of the startup, because this is something that will come back to haunt you if you don't do it right away. So what we'll be looking at, what I'll be discussing is more generally the due diligence, and Bianca will be discussing a little bit more in detail the whole intellectual property part, because I think this is something that's of great interest for you guys. Now, what I'll be discussing is, what are the types of things that people or potential investors will be looking at, the process, and also the impact of due diligence. Now, as far as what investors would be looking at, they would start by trying to ascertain the corporation's capital and corporate matters. So they'll want to make sure that they know and that what are the shares and other securities that are being that are outstanding, including the options that are granted to employees. And the investors are obviously interested in knowing that, because we'll tell them or confirm what is the share of the corporation's equity that they will acquire as a result of their investment. They'll also want to make sure that the corporation has the capacity to issue those shares, and also that the representatives will sign the deal documentation, have the authority to sign those documents. Now, in order to do that, it will certainly take a hard look at your minute books. And I know that for some of you, maintaining minute books is probably something that's particularly annoying, but it's important to do it from the get-go. It's important to obviously take record all of the annual resolutions or shareholders resolutions, directors resolution, properly approving bylaws, the share subscriptions, obviously the grant of options, transfer of shares, nomination of directors. That's obviously, and in connection with that, I think some of you will issue shares or grant options to consultants or contractors who have been working with you on with the company, or to employees. And if those employees or contractors are no longer involved with the corporation, it's important to think about maybe trying to repurchase those shares from the contractors, because or the employees, because or even if it's unclear, sometimes you don't even issue shares, but you've promised shares, and you need to make sure to deal with that as you go, because once you're going through a financing, the investors will be looking at that and see, well, has there been any promise of issuing share to somebody that maybe not recorded in the minute books, but you've promised that. And then it comes back to haunt you if the employee, knowing that now you're going through a financing, they can use that to try to get money from you, and you want to clear all of this. Usually try to get a release from employees and contractors for this. Also, in the context of the due diligence, the investors will want to make sure that you have good title on your assets. So typically assets, you have real estate property. That's probably a little bit less of a concern for startups, assuming you don't own necessarily all big buildings, and especially in the technology field, it's less of a concern, but also making sure that you own your equipment. And of course, one of the big deal is making sure that you have due title on your intellectual property. And that's something that Bianca will be discussing with you. We'll also be looking at whether your assets, and they'll be looking at personal property, security, or movable hypothec kind of registries, to make sure that your assets are not, or if they are, that they know that your assets are encumbered by, let's say, a hypothec or mortgage, which would allow potential creditors to actually take property or ownership of your assets if you don't pay your debts to those creditors as they become due. They will also look at what are the potential liabilities and for the corporation. What are the potential liabilities through contractual undertakings? So we'll take a hard look at reviewing material contracts, or all of your contracts sometimes, to know what are the obligations of the corporation. And also they'll also want to know if you are in disputes or potential disputes or litigation with any third party. And again, you probably want to disclose that from the get-go, but they can also have access to public records to figure that out. Bianca will also provide a little bit more details on that. And with respect to intellectual property. And they also want to see if the corporation can contractually rely on future cash flows, which is obviously a big part of the valuation of companies. So does the company have contractual rights to potential revenues. And if they have contracts that provide revenues, well, are these contracts subject to termination easily or soon, or even will the financing actually create the termination or any kind of restriction of those contracts? They'll want to know about them. So that's basically, in a nutshell, what an investor would be looking at. Obviously, it gets a little bit more detailed, but in terms of the type of due diligence and the process, well, the due diligence will vary in scope depending on many factors. So the industry the business operates in. Now, as you can imagine, for you, there will be a big focus from a legal perspective on the intellectual property, the size of the investment. I think Scott alluded to the safe, type of investment. Usually, because those investments are somewhat smaller in scope, it will be quicker. There will be some due diligence, but perhaps a little bit more limited than if you go all in with a big type of investment and a larger scale investment that's an actual equity investment for some amount of money. It will depend on the risk tolerance of the investor and the cost and time constraints, obviously, and whether or not it's debt or equity financing. An investor in debt will focus more its due diligence on ensuring that debt will be repaid, while investor in equity will be more interested in knowing what is the potential growth of the corporation. Now, as far as organizing the due diligence process, so next slide. Now, first of all, you should start thinking about it now, as I was mentioning before. A successful due diligence from the company side, which will in turn facilitate the negotiation and the transactional process, will depend on your capacity to provide information and documentation requested. So should have in mind to document contractual undertakings, consider seeking IP registration where possible. Bianca will discuss about that. Sign employment agreements, sign service agreements with your contractors. And I know that people are really sensitive to that in this group. We've looked at a few of those. And of course, maintain your minute books, as I was mentioning. So, and you should make sure that you archive those documents as you sign them and enter into those documents. So as far as process is concerned, then the first thing to do, obviously, before engaging to due diligence with an investor is to sign an NDA. It's before you provide any confidential information or sensitive information. It's important to have that in mind. And even if an NDA is signed, then you should consider what type of information you want to provide, or some of it you may not want to provide at all, or very limited manner. For example, proprietary source code of a software, like the Coca-Cola formula, basically, of your company. You may want to think about whether you want to disclose that at least in the early stage of the due diligence. Then the investors will often request documents. They will be generally organized by topics. There will be, usually you'll deposit that on an online platform, and that may come, at least from a due diligence process, that may come after a term sheet is entered into with respect to the investment. Now, and you'll want to also discuss the scope, the areas of focus, the materiality thresholds for the due diligence, and that will be usually discussed as the investor provides the due diligence request list for the documentation. Now, sources of information for due diligence are obviously, as discussed, documents, access to management, and publicly available information on public registries, land registries, or IP registries and whatnot. So I'll skip over the next one, just quickly, the type of information that are looked at on slide 4, I believe, Bianca. Yeah. So as you can see, that's just a slide where you can see the type of information that are being looked at during due diligence. And now the impact on the transaction of due diligence, well, it will impact sometimes the deal structure. If the due diligence reveals significant liabilities relating to the business, or if the issued and outstanding capital of the corporation cannot be properly ascertained, then the investors may try to avoid assuming these liabilities or seek to ascertain your corporate standing by negotiating a restructure of the deal, investing in a new corporate entity, for example, that will require the relevant assets of the business that you've been constructing, so that you've been working on. Now, this may obviously create some hurdles when you have to transfer assets from one corporate entity to another. That might be a problem. So this is why, trying to limit your liability and making sure that it's proper, that it can be properly that the shares in your your equity, your outstanding equity, can be properly ascertained is very important. It may of course have an impact on the subscription price or the investment price of the investment, because obviously if there's more liability, or if the valuation is not as initially represented, then even if you have a term sheet, which are obviously term sheets are non-binding technically, it could be reasons for an investor to reduce the subscription price. It will have an impact on the representations and warranties that are being sought by the investors. If there is more risk related to the company, they will try to limit that through providing a more robust set of representations and warranties on which they can seek indemnification if the representation and warranties are not accurate. It will have an impact on indemnification if there's a potential risk that is identified through the due diligence, and that investor is not willing to take on that risk as it invests in the company, then it may seek some specific indemnity in respect of which that liability will be transferred upon, sometimes even to the founder. So obviously you want to avoid that. It will have an impact on the disclosure schedules. Obviously, the due diligence will feed what you will be disclosing as part of the representation, the disclosure schedules that you're providing in response to the representations and warranties. It may ultimately, if the due diligence process is not satisfactory, it may lead to the deal termination. This is something that you want to avoid, and there might be pre-closing covenants or requirements, such as trying to correct some deficiencies. For example, it very often happens with respect to minute books when the investors find out in the due diligence process that some documentation is missing. They will ask for those deficiencies to be corrected. And on that, I will pass it on to Bianca.
Thank you, Mathieu. So IP due diligence is a very specific type of due diligence. Just as a reminder, IP is really defined as an intangible asset under the law. So even though it's intangible, you really should treat it as a corporate asset nonetheless, especially during the due diligence process. So what does this mean for you? This means documentation, documentation, documentation. I cannot stress that enough. The easiest way to show that an asset exists and has value is to document it, whether that means through contractual documents, relationships, or through formal registrations at the federal government level. So we really go through a process of IP due diligence, and you have on the screen the steps that we will take. So the first step is the identification of an IP asset. What we're going to request is that the target company provide us with a list of any IP that they own or that they use through licenses. And the purpose of this is really to ensure that we have a good picture of what type of IP we're looking at. As I'm sure you can imagine, deals that are focused on a trademark heavy IP portfolio are going to be treated differently than deals that are focused on patent heavy portfolios, especially through the due diligence process, because there are different considerations that we need to look over, in particular when we're considering materiality. I've never seen a IP due diligence that was perfect 100%. What that means is that there's always some little, oh, maybe we have a little part of our IP that isn't quite documented, or we need to go get some additional releases, or there's always some little adjustment that we need to make. And our job as attorneys is really to verify and advise you, okay, well, if we get this documentation, if we get this little adjustment, is it going to damage your IP portfolio, and what is the material effect on your deal? The importance of working with an IP professional is that they can give you that advice and they can help you in making those adjustments and making that documentation so that you can ensure that the IP is transferred to the buyer and there's no material impact on the price or any liability that can come as a result thereof. So the important thing is to really identify your IP assets. And in this scope, we will also ask that you provide us with any registrations. Not all IP is registered. And as I'm sure you already know, you can have, in Canada especially, trademark rights and copyright rights that fall under what we call common law rights. So the use of the trademark or the very existence of an artwork or what we call work under the law will automatically award you with trademark rights or copyright as the case may be. So if you're going to rely on common law rights, it's very important to show your IP professional how you document that, whether that be through an internal portfolio that you have that documents use, or for copyright, it might be an email to yourself that shows when the work was created, or any internal documentation that you may have that shows that those rights exist and can be transferred. The second step that we're going to look at is ownership and status of IP. So we're going to have a review of all your internal documents, including contracts, to confirm that the IP asset exists, is accurately described, and that there's no encumbrances or issues on those assets. So what does that mean? Sometimes when you get mortgages or loans rather in order to get financing, the bank will request that you have, they'll put a mortgage on all of your property. That often includes IP. So it is important that when we are requesting those releases, that the IP assets are accurately described so that we do in fact get that release and your IP assets are free and clear. Another important issue with respect to accuracy of information disclosed is that when you're going to be transferring assets to a buyer, it is important that the asset is correctly described. This is particularly important with respect to patents and inventions. You don't want to be accidentally giving away more than what the patent is supposed to cover. One thing to remember is that IP assets tend to be very precise. So they'll cover one specific part of the invention or one specific aspect of the trademark. So you may not want to give away the entirety of your IP assets, especially if you're only assigning a small portion of your business. Some common things that we will see is that we're going to be asked to list the status of each IP asset. So is it registered? Is it not registered? Will the renewals be coming up soon? Have all the fees been paid? This is just standard run-of-the-mill information that you should have handy, and you should be able to communicate to your IP specialist fairly easily. If you do not have that information, do not worry. We've got lots of internal databases and we can conduct searches to obtain all that information for you. What we will ask, and what is very important on your end, is that you are familiar with your IP assets, because we're going to ask you to review and to make sure that all of that information is correct and up to date. The last portion is development and acquisition of IP assets. This is particularly important because this can have an important implications on your title. So who was the IP developed by, or was it acquired from somebody? When you're working with employees, consultants, or independent contractors, or even third parties, do you have appropriate assignment provisions with these individuals? Have you obtained a waiver of moral rights? If there are issues like the transfer of ownership is not complete, or you don't have that moral right, you will almost always have a buyer who's going to request that those rights be perfected as a post-closing item. Nobody wants to buy an asset from you if they're not going to actually own that asset. So very important that when you're entering into these contracts or into these relationships with employees or independent contractors, that you include an IP assignment clause directly into those agreements and a waiver of moral rights. We encourage strongly that you speak to your attorneys or your IP professionals, because they do have standard language that they would be happy to share with you to make sure that those contracts are complete, and that should you ever decide to sell your IP assets, you are in fact the owner of those assets. So we've got also some IT due diligence that we, did I skip? Sorry, I skipped a slide. We've also got some IP related agreements that we're going to be looking at. In particular, we're looking at license agreements. And what's interesting for us in the license agreement is any restriction that it can place on third parties with respect to the use of IP rights. So for those of you who may or may not know, licenses do not afford you ownership of IP, but rather use. And use can be subject to particular restrictions, such as you are only entitled to use a particular piece of IP on a certain territory or for a certain amount of time. Oftentimes what we see in licenses is that you cannot assign that license without approval from the licensor. So we're going to be looking at those approval clauses. If you do have such language in your license agreements, it is important to get that approval as soon as possible to not slow down your transaction. Another important thing that we're going to be looking at is IP protection and enforcement. If you have IP registrations, and you should, we strongly encourage that you do, have you been policing the market? Are you making sure that nobody is inventing something that's in violation of your patent? Are you making sure that no one is using your trademarks in maybe a different part of the country? So any policies or practices that you have in place, oftentimes what we strongly encourage companies to do is to have an internal IP policy that teaches employees what to be looking for, what to do in the event they do see some kind of infringement. That adds value to your business, and it is very helpful for us to know and for you to disclose that to your buyer, because it does have an impact on the value of your IP. And disputes. I do want to talk about litigation a little bit, because I think when people see the word disputes or litigation, it makes them very nervous. Not all litigation is bad litigation. In fact, there is such a thing as good litigation that can add value to your IP. If you are the plaintiff, if you are the person who is going after individuals who are infringing your IP, we consider that as good litigation, because it is showing that you are policing your IP rights, and there may be a payout for you at the end of the day if they are in fact found to be infringing by the federal courts. You could have, you can go as far as getting damages or a portion of the profits that they made from the infringement of their IP. So this is considered as an asset in a due diligence procedure. What you need to be careful of is bad IP litigation. What is bad IP litigation? Any litigation that is seeking to invalidate your IP assets, to have your IP removed from the registration, or anything that would be considered an opposition at the registration level. That is bad IP disputes. And why do we call it bad? Because there is a risk for you to lose your IP assets. at the end of the day, what we will do as attorneys is conduct what we call IP litigation searches. So we will check the court registries at a provincial and federal level in the jurisdictions that you indicate to us you have IP assets, to make sure that there is no IP related litigation. If there is, then we're going to go a little bit further and see what it is. Has there been a settlement? Is it bad or good IP litigation? And then advise you as to how this is going to impact the overall value of your IP. What is important is to always disclose to us and to the buyer what litigation you are involved in, what is the relationship between the parties, how contentious it is, and what is the risk that you will lose your IP assets, because that's something that a buyer would absolutely want to know. All right. The second important...
sorry to interrupt, Bianca. I just want to do a little time check. We have about 6-7 minutes left. And just in case we have questions, so.
Perfect, thank you. Well, if you do have questions, please interrupt me. I'm on the last slide, so we should be done shortly. The last portion of our IP due diligence really has to do with IT software and software systems. What we're going to be requesting here is to have a search done, often by an independent third party who specializes in IT. They will test the IT systems through a due diligence process. Normally, this is a kind of penetration testing where they'll make sure that the IT systems are basically commercially viable and appropriate for the needs of the business. We will want to have any disclosures with respect to any material failures. Have you had any phishing incidences, anything of that nature? The importance of the IT system varies from company to company. So it's important for us to know what your business model is and what role the IT systems play in that business model. Some other important aspects are also the websites and social media. If you do use social media, just make sure that your postings are protecting your IP assets. So are you making sure that your trademarks have the little registration symbol associated with it? Any information that you are posting on social media, do you have title to those IP assets, and can you properly transfer those assets? So for example, if you've got a number of domain names, are they registered, are they up to date, and can you transfer them? So that's basically what we're going to be looking at. And the last piece is privacy and data security. So on the privacy note, you may or may not know we're having a revamp of our privacy legislation at a provincial level in Quebec. So very important to make sure that you are up to speed with not only the privacy requirements at a provincial and federal level, but you're respecting CASL and anti-spam legislation. So we will be asking for all your privacy policies and how you obtain consent from your users and just what you generally do to make sure that you're not in breach of any privacy legislation. And that is essentially the scope of an IP due diligence exercise and what we will be looking at. Are there any questions? I suppose to end on, I can probably make the following comment. The biggest mistake I see in due diligence, and Mathieu can speak on this as well, is just not getting a sufficient disclosure from the target company for whatever reason. Either they think something's not relevant or they're concerned with confidentiality. We as attorneys do have solicitor-client confidentiality, so we will absolutely protect the confidentiality of your information. And I would rather have a full disclosure than have a partial disclosure, because we really can't protect you against things we can't see. So if something really isn't relevant, we will absolutely tell you, and we're there to help you. So we will advise you if we think there are any issues or any concerns. So please do disclose as completely as possible so that we can absolutely help you on that.
Thank you so much, Bianca. Thank you, Mathieu. Thank you, Scott. Is there any questions about any of the presentations? We have a few minutes left if you have anything.
Can I just ask my question?
Of course, go ahead.
Well, I actually have one question for both Panache and Norton Rose, if that's all right. So for Scott, I'm curious, you were speaking earlier about essentially matching risk or understanding the perspective of risk from the fund's perspective. and basically determining your market size and I guess your addressable market. But at the same time, trying to be realistic, because in the due diligence process, that might come back and bite you. What do you think about potentially making like a scenario analysis or giving a range of potential like addressable market in a pitch deck, for instance, or when you're pitching to VCs?
That's a great question. So I would say that you need to display that what you do is focused enough that it addresses a single market. I don't think it's a good idea to show, let's say, auxiliary markets and optionality and if this, that. I mean, it's generally going to be presumed that along the way, you'll need to make adjustments to your product and to your strategy. And what a very early stage investor is doing is betting on you to make the right decision. So choose one market, make sure it's big enough, and demonstrate how what you're doing solves an incredibly painful problem for that market. And the incredibly painful part is the thing to remember. It can't be like there's a cliche where it's a vitamin or a painkiller. Make sure that you're not going to market with a vitamin, a nice to have, something that's good for you that you ought to take once a day. Go out to the market with a painkiller and find the person or user who is experiencing that pain the most acutely on a daily and recurring basis. And that's how, once you've done that, you really just want to make sure that the market itself is not so niche that it prices you out.
Okay. All right. Thank you. Appreciate it. That was really clear. And I have a question maybe specifically for Bianca. Like, given the recent developments with, like, let's say Miramax and Quentin Tarantino and everything that's been happening with that, how important do you think it is for us to kind of protect ourselves with, let's say IP assignments, or maybe I'm not using the right words, but for like NFT usage and the rights to NFTs and so on and so forth?
It is very important to protect anything that you can do to not only show that you do have rights in something, or to paper your relationships is very important. I recently did due diligence where one of the companies had to indicate that they had a bunch of handshake deals. And that became problematic for the buyer because we put in language in our assignments specifically that it should an asset have to be assigned to a third party, what will happen. So you don't have all of those, we call them belt and suspender language in a handshake deal. You'll just have it on what the main asset is. So yes, please do paper your relationships, paper your assignments, because an attorney will put in language that you may not think of in the moment. Our role really is to avoid litigation at all costs. So we do everything we can to put in all of those general provisions to ensure that should you have to assign, should you have to maybe terminate the agreement, what will happen and where do the assets go?
All right, understood. So it sounds to me like you just protect yourself as much as possible, as early on as possible. And if you don't end up using it, all the better.
Exactly. Better to prevent a dispute than to have to try and correct the problem afterwards. Once you're in a litigation situation, we do a look back. So we'll go back to when the IP was created to see all the relationship. And if something isn't papered correctly, it becomes harder for us in a litigation situation to then make evidence that it does exist.
Okay, understood. Thank you.
Perfect. Any other questions? It's already noon. I know everyone must have either lunch or another meeting to get to. So if there's no other questions, thank you.
I have just
Oh,
one,
go ahead, yes.
one hopefully very quick question to Scott. Different investors seem to have different philosophies around how early they want to sort of start talking to you. Some are like, when you're investor ready, come, and then we're very quick on making decisions. We don't need to have known you for 200 years to see how you've evolved and stuff like that. And other investors, are more like, no, we want to see your evolution, get to know you, take our time. So, and I feel like maybe this is more the conservative investors, maybe more like Canadian style. So I'm just curious to get your thoughts on that.
Yeah, that's a great question. I think that when you're having an early stage discussion, like prior to launching your fundraise, you're in a situation where you have very little risk. You have nothing to lose from having these conversations. So your objective in those discussions shouldn't be to, let's say, establish the framework for a future fundraise. I mean, you're certainly building trust by engaging with them, but I think what's really important is that these investors will see a lot of companies just like yours. And if they've seen 10 or 20 different Uber for dog walking businesses, they'll have an opinion on what it takes to win the Uber for dog walking space. And they'll tell you that because ultimately they don't want you to go and build a product that no one's going to buy. And if they've diligenced a ton of businesses in your space, then I really think it's worthwhile to open up a discussion with them and get their feedback. So it's like more of a collaborative discussion about refining your either positioning, your communications, or maybe the product direction, rather than just having a very long and protracted fundraising discussion, which I could understand why many investors would not want to do that until you as a founder are ready to say, okay, we're raising now.
Got it. Thanks a lot. And maybe a quick follow-up on that. Does Panache have a thesis?
We certainly do. I didn't want to spend too much time on talking about Panache because this is really more about you guys, but we're a pre-seed and seed stage company, which means we typically write checks around $500,000. We'll write 2 checks, so a pre-seed and a seed round, or a seed and some of a Series A. We are agnostic of sector, which means we invest in all kinds of different businesses. The one thing we're very strict about is stage. So we won't generally take a position in Series A and later unless there's sort of some history there. We will lead deals. We will follow deals. We will put together syndicates. We will make introductions. I would say that in a word, our view is that we are very early stage and that we are a generalist fund.
Okay, thanks a lot.
I have a last question. So let's say you're trying to calculate your 1 million ARR really to get to that next level, and let's just say you're selling a product that costs $50,000. Okay, the cost of good of making this product, let's say, is $30,000. Your profit on that cost is, let's say, $10,000, and then after that, your your annual recurring revenue is $10,000 out of that. So if you calculated that at $50,000, that would be, let's say, 20 units per year, right, to get to that 1 million. Now, do you calculate it on the 10,000 or on the 50,000? Because if it would be on the 10,000, that would be 100 units. So how do you see
great
that?
Question. It's so revenue in the sort of like vanilla sense. So it's top line revenue. Sales is a good way of putting it. What's important is that venture capital funds we're not super concerned whether or not you're profitable or how quickly you'll get to profitability. What we care about is, can what you're building be massive? Can it be massive? Can it be worldwide? And are you the team to execute on this massive idea? So in the short term, what they're really looking for is revenue, but that's just kind of a proxy for growth. It's like, how is this company growing over a long period of time is a very important part of how they're going to measure it. And revenue just happens to be a very common traction metric, but it doesn't need to be, right? You could, if you had, let's say, a freemium model and you were able to brag about really, really excellent retention rates and low churn, like that can be something that, particularly if you're raising in the early stages, can be very, very helpful.
Okay, that was my question. Thank you.
Well, thank you, everyone. I hope you've gained some really interesting insight and feedback on this event. Please note that the presentations will be sent out to you. If ever you have any questions, you can reach out directly either to Zoo, or we'll also forward the contact info of Scott, Mathieu, and Bianca for additional questions through emails if that is the case. So thank you, everyone. I hope you have an amazing afternoon.
Thank you, everybody.
Thank you.
Thank you, everyone.
Bye.
Thank you. Bye.